Hello, my name is Hamish Limbu, and I will be speaking on behalf of the team that has been recruited to provide a video analysis on our financial report that involves trading strategies and quantitative equity investing. This section focuses on evaluating trading strategies within hedge funds. In 2.1, we had used performance metrics to evaluate different hedge funds. I will be providing a few of these metrics that we have evaluated. For Global Macro Hedge Fund, we found their arithmetic average return to be 11.51% and their geometric to be 11.62%. This demonstrates stability and minimal impact from the market's volatility. For the managed future hedge funds, we found their annualized volatility to be 11.69% and their Sharpe ratio of 1.82, which suggests a positive trade-off and is a fund that is more suitable for risk-tolerant investors. For 2.2, we created graphs for the GMHF's cumulative return and drawdown, where they face its highest drawdown of 27.01% in September 1999, which was impacted by the Asian financial crisis and dot-com bubble. Their cumulative return for an initial investment was the best out of all funds annualized. In factor models, the multivariate regressions include additional factors like size, value, and momentum, which provides deeper insights into the fund's investment style and diversification strategies, which should be used over univariate regressions. Finally, analyzing illiquidity, the convertible bond arbitrage's funds beta increases when considering longer timeframes, indicating that illiquid assets require extended periods to accurately measure performance relative to the market. This analysis on hedge fund trading strategies reveal how funds navigate through market complexities and utilize performance measures, risk management, and strategic allocation to achieve higher returns. The diverse range of risk and return profiles examined in this section emphasizes the necessity for investors to consider differing performance measures and market conditions to ensure decisions are informed through comprehensive understandings of the underlying dynamics of hedge funds. This section evaluates the effectiveness of a strategy called industry momentum and how different trades and backtesting impacts the feasibility of the strategy. In 9.1, we measured performance in differing industries where telecommunication had the lowest rank of 14.04 and electrical equipment had the highest rank with 17.17. We used momentum investing as the ranking methods were assumed past winners to continue to perform. We also found the automotive industry to be cyclical as displayed in the graph on the right, performing well during economic expansions and poorly during contractions. Momentum investors would focus on higher performing sectors and adjust their portfolios according to assured profit. In 9.2, the winner portfolio consisted of the top 15 industries and had an average monthly return of 0.95%. This return suggests that the portfolio on average outperforms the market by 0.95% per month over the time horizon. This is considered to be a genuinely profitable strategy that performs better than the market but suggests risk-adjusted returns could be improved. For 9.3, the loser portfolio is made up of the bottom 15 industries and had an average monthly excess return of 0.49, which shows a profitable return but not as good as a winner's portfolio. The index's annualized Sharpe ratio of 0.389 is less than the winner portfolio and higher than the loser portfolios. Investors should focus on Sharpe ratios if they seek to make the most profit per unit of risk. Within 9.4 for industry momentum portfolio, we found that they are outperforming the market after adjusting for risk, and there is an inverse relationship between the portfolio's return and market returns due to a number shown on the side. For 9.5, after producing the graph as shown, we believe longing winners based on monthly momentum is viable with frequent rebalancing. Shorting losers can be a useful strategy during projected or ongoing economic downturns, and the long-short strategy can hedge against losses even for winners' portfolio during downturns. Within 9.6, in July, August, and September 2009, significant losses were observed as the market rebounded post-global financial crisis. Industries previously considered winners were heavily impacted, turning into losers. This shift resulted in shorted stocks outperforming long positions. In 9.7, historically the best end for industry momentum strategies was 12, balancing high returns with a Sharpe ratio of 0.586853. Smaller ends like 2 yielded higher returns but with increased risk. Thus 12 is optimal for balancing risk and return. This analysis of industry has yielded great insight into the nature and effectiveness of industry momentum trading. Our analysis revealed key insights into industry volatility over time measured through annual returns across several months. Ranking these returns has helped us understand each industry's sensitivity to economic cycles. Portfolio analysis showed that investing in winner industries based on momentum is effective for risk-adjusted returns with disciplined rebalancing. And shorting can be useful but should be limited to short-term use due to the historical rise in equity securities driven by the equity risk premium. Thank you for listening to my video analysis.